Malaysians do not meet the minimum pension target of 240,000 ringgit. With rising inflation and severe economical challenges, many Malaysians resorted to withdrawing from their employees' provident fund or EPF during the pandemic, just to reduce their financial burdens. You may have heard of these cases, particularly when the iSinar and the iLestari initiatives were in effect. On top of that, EPF saving accounts have a dividend payout of 5.35% in 2022, which means that the growth of retirement savings will be also somewhat limited. So how else can I increase my income and grow my retirement savings? In this video, we'll share with you a couple of ways to invest in US stocks to help you retire comfortably. Firstly, when adjusting retirement investment vehicles, you should adjust them according to your risk tolerance and your retirement goals at different stages of your life. A common approach will be to use the power of compounding interest through long-term investing with the goal of continuously accumulating asset appreciation. Let's take US tech giant Microsoft as an example. If you were to invest $1,000 in Microsoft stock 10 years ago at $34.70 per share, that same $1,000 would have grown to over $10,000 today. That's a return of over 900%, outperforming the annual dividend rate of 5 to 7% for EPF by a landslide. The idea is to choose a good company with high growth potential, buy at a reasonable price, and hold them over a long term. Then all you need to do is wait for the stock price to reflect its true value and you'll be able to build more wealth. However, if your risk tolerance is low, you can adopt a more conservative and prudent investment strategy for the US stock market to help you achieve your retirement goals. You can do this by investing in US stocks that have a dividend yield of more than 5%, such as Altria Group and Verizon, whose dividend yields are 8.1% and 6.9% respectively. These companies have a stable cash flow and a long history of high dividend payouts, which will allow you to receive a consistent dividend income every year. In fact, as long as you have the right investment strategy and stock selection, investing in US stocks can help you increase your wealth and help you achieve your retirement goals. And with M Plus Global, you'll be able to do just that. You can trade various blue chip stocks, high yield stocks, ETFs, and find more opportunities in this vast and open market. Open an account with M Plus Global today and start trading US stock. To see more videos from M Plus Global, subscribe to our YouTube channel today. M Plus Global, winning the world.
Mungkin anda berfikir bahawa saham syariah hanya terdapat di pasaran saham Malaysia sahaja. Sebenarnya, ini tidak tepat. Anda boleh menemui pelbagai peluang pelaburan syariah yang baik di pasaran Hong Kong dan Amerika Syarikat. Ini termasuk saham-saham terkenal yang mempunyai rekod bukti prestasi pulangan jangka panjang yang mengagumkan, seperti Apple, Tesla, Visa dan BYD. Disebabkan oleh proses penapisan yang kompleks, proses untuk mengenal pasti saham syariah boleh menjadi agak rumit. Oleh itu, M Plus Global telah menjalinkan kerjasama dengan Ideal Rating, sebuah syarikat solusi pelaburan syariah yang terkemuka di dalam industri kewangan global. Semua saham akan disaring mengikut piawaian syariah profesional. Ini bagi memudahkan pelabur mengenal pasti saham-saham syariah. Bagaimanakah anda boleh mencari saham syariah di M Plus Global? Di dalam aplikasi kami, anda hanya perlu mengetik markets dan pilih sama ada pasaran Hong Kong atau Amerika Syarikat. Kemudian, di bawah pasaran tersebut, pilih syariah untuk melihat senarai semua saham syariah yang tersedia di pasaran tersebut. Sekiranya anda sedang mencari saham yang tertentu, anda boleh melihat status syariah di bahagian penjuru atas sebelah kanan halaman butiran stok. Anda akan nampak satu ikon bulan sabit hijau jika saham tersebut adalah syariah. Jika anda menemui saham yang diingini tetapi ia tidak syariah, anda masih boleh menyemak status terkininya dari semasa ke semasa kerana kami akan mengemaskini senarai saham syariah dengan kerap. Dengan M Plus Global, anda boleh mencari saham syariah dengan mudah dan juga membina portfolio ideal anda. Jadi, jangan berlengah lagi. Bukalah akaun dengan M Plus Global pada hari ini juga dan mula berdagang saham syariah. Untuk menonton lagi video-video daripada M Plus Global, ikutilah saluran YouTube kami.
M Plus Global, winning the world.
So you want to buy Hong Kong and US stocks but don't have enough cash? Upgrade to an M Plus Global Margin account. One of the common concerns amongst traders is not having enough funds. But now you can leverage and maximize the funds you have on hand with an M Plus Global Margin account. For example, if you were to buy one Coca-Cola share worth $60 in the US market but don't have enough cash in your account, our systems will automatically assess the holdings and cash available in your account to determine your buying power. To find out how much margin financing is available for you, let's take Coca-Cola as an example. The maintenance margin ratio is 43%, which signifies that you are only required to pay 43% of the total amount to purchase the stock. The margin account will involve interest. Here it shows a financing interest rate of 20%, or no interest if it is an intraday trade. How exactly do I activate a margin account? If you don't already have an account, check the margin account option when you open your account. If you already have a cash account, just click on Trade Margin Upgrade. Then read and agree to the terms and conditions and submit your application to upgrade to a margin account. How do I check the flow of foreign exchange conversion? For both cash and margin accounts, payment differences involving cross-currency payments will result in foreign exchange conversion. Can be viewed by clicking on Trade More Fund Details. Is there anything I should take note of when it comes to margin account? You have to keep an eye on the risk status of your account by clicking on Trade Risk Status. In the event that your account reaches the danger status due to a sharp fall in the market, you will need to deposit sufficient funds or close some of the stock positions to bring your account back to a medium risk level. With M Plus Global's margin account, you can amplify your trading capabilities and broaden your asset choices. To see more videos from M Plus Global, subscribe to our YouTube channel today.
M Plus Global, winning.
Hi, good evening everyone. Welcome to our market outlook for third quarter, and I'm Loui Low here. And today we are going to present you with a lot of insights, especially what we are going to find out also in third quarter, because I think a lot of people are expecting recession, expecting all this inflationary pressure and also this elevated interest rate environment to actually make some impact towards the corporate earnings. And therefore, today we are going to present you with the third quarter market outlook. And before we go into that, perhaps you can also check into our M Plus Global app. Our M Plus Global app will offer you a lot of information in there, especially the news section, and also one article per week by our research team. Okay, so let's move in to our slides, and let's check out what sort of insights that we can provide to you. Okay, before we start, just to give you some new user guide, understanding of where can you find some insights from our M Plus online, also M Plus Global. We have weekly bites as well. We have our research report being published on our M Plus online blog. And also do check out our M Plus online and M Plus Global app. These are two different apps, but they provide you with the local domestic stock exchange and also the global US and also Hong Kong stock exchange trading opportunities. And besides that, we also have the YouTube channel and also Facebook. Do follow us and also click like and share it out to your friends. And yeah, so before you start, we have some disclaimer to talk about. These slides here is for your own reference purposes, and perhaps if you want to buy or sell, please also get some advice from your investment advisor before you do any investment decision. Okay, so let's start off with today's agenda. We have something to talk about the recovery theme, and also we have some global catalysts and also Malaysia catalysts as well, and we also do some economic review and outlook, and perhaps everyone would actually stay until the final moment about the Malaysia and also US and also Hong Kong stock picks. We have pretty systematic approach since a few quarters ago on Malaysia stocks exchange, and we have found we have developed a systematic approach for the US and also Hong Kong stocks as well. That has garnered us some good returns as compared to the Hang Seng Index and also the S&P Index as well. So that would actually give you an understanding of what sort of sectors you should be looking at as on a quarterly basis, and what sort of investment approach that we are using, as this is a very so-called portfolio rebalancing model that we always use for quarterly base on a quarterly basis to select at least 10 to 13 stocks per quarter. Then you rebalance that portfolio per quarter. So every year you are just using the earnings. You're trying to play the earnings kind of portfolio. So perhaps that will give you an understanding of perhaps this would be also very useful for you to build your own model. But as of this juncture, we have started the global journey since last quarter. So last quarter we did put in 10 stocks for the US and also 10 stocks for Hong Kong. So let's see whether this round whether our stocks can actually perform well in the third quarter or not. Okay. So on the recovery team, we have mentioned about this recovery team for a very long time, and perhaps everyone doesn't see that after China reopening, where is the growth? Where are the growth to be seen in the global economy? So first of all, we have to understand that even our side, even from Malaysia side, since April last year, we have actually reopened most of the business activities. But generally speaking, we don't see a very strong growth in terms of corporate earnings. But perhaps people are actually affected, or corporates are actually affected by inflationary pressure and things like that. And if you look into China reopening during January, what sort of ideas that we can gather is that they might be not, they may just go for traveling within the domestic region, and therefore because it is a Chinese New Year period, so perhaps Balik Kampung theme during that period suits for China side. And if we want to talk about global recovery from the China tourists, it may actually delay until the second or third quarter. So we need to actually check for second and third quarters earnings on most of the companies, even for the aviation, tourism, hotel industry, or even the cruise. So that delayed earnings can also come in during the second or third quarter. So let's check out by then during the earnings season. So I can understand that throughout this period of time, despite all this recovery team play, we only see actually the discretionary spending has been going up. Like for instance, LVMH has been going up, the earnings has been going up. And also recently, we have also noticed that the cruise liners are actually having some good, beating in earnings, such as CCL and also RCL, this Royal Caribbean, cruise, and also the Carnival Corporation. So basically, what I'm trying to say here is that perhaps first quarter we did not see a good recovery is because everyone is actually spending their money domestically in China, but perhaps these delayed earnings can also be seen in the second and third quarter from all this discretionary spending going forward. So what we are seeing here in this slide is that to say that Chinese tourists are ready to hop on cruise trips abroad, but this may delay into second or third quarter or even until the rest of the year. So let's check out the earnings by then, and even we are talking about the Chinese returning to Europe to spend, is all those big spenders. Some of the articles that I read is that they rather spend within China, means that they are spending inside China. So perhaps the delayed earnings can also be seen during second or third quarter when they are traveling abroad. So I'm still banking on this recovery. I still believe that China side has a lot of improvements going forward. So just bear with it. I think people are looking at instant gratification of once they reopen, then they will spend everywhere, right? So perhaps this may actually delay until second or third quarter. And for tourists, visitors, arrivals in Hong Kong is actually back to pre-pandemic level, but it's not at the peak of 2019, towards that region. But it's like it's back to normal. I would say that tourists in Hong Kong is back to normal. So perhaps we are in this is a normal pace for for Hong Kong side. But once it is able to boost all these arrivals to the mid 2019 kind of figures, then perhaps that makes sense for overall what we are looking at for the overall tourism segment. So Malaysia side, we also can see that after we have reopened, certainly we are seeing a very strong growth until the recent days, which is December last year. We have hit about 1.8 million arrivals so far, and in that particular month. And this is also within the average range of 2 to 2.5 million kind of range going forward. So we are expecting that to happen within this, at least for this upcoming few months. We're expecting this kind of rate of tourist arrivals into Malaysia. So generally speaking, we are looking at about 16 million tourists by this year, and also first quarter we already hit about 4.5 million tourists. So if you extrapolate that 4.5 million, that is about 18 million. So that is within the target of our Malaysian tourism department. So that is the outlook for the recovery. So in summary on the recovery team itself, I'm still looking at a very good position for China side to recover back to pre-pandemic level. Just that people want the real impact, the straight away impact. But I would say that the first quarter itself, a lot of people are spending money domestically in China, and therefore the earnings to most of the corporates in the global region, it might delay until second or even second half of this year. So on the global concerns wise, let's check it one by one. US banking crisis since February, March this year, we have noticed that it has been stabilizing and confidence level has been increasing. But whether this one-year bank term funding program, which will be ending on next year, March 2024, will that actually come back and haunt the investors in the global region? Because right now they are actually putting out this bank term funding program just to make sure that the liquidity is there, and so that the investors regain their confidence, or the depositors regain their confidence in banking sector, banking industry. But what if in next year media will pick up this again, and let's say there is another issue down the road, whether that will actually trigger another concerns or another crisis by then we have to monitor until that period of time. So right now we are actually kicking the can down the road. So let's see what's going to happen nearer to that, which means maybe by end of this quarter, end of this year, and 2023, which means that October to December period. Let's see whether the media will actually pick up this bank term funding program, which will be ending in March 2024. So another thing to concern is that the heightened inflationary pressure, which is currently is still very much elevated, but it is on a gradually declining manner. It is not up to the Federal Reserve's liking. They still want to see the 2% year-on-year position for the CPI numbers. So right now it's currently at 4.9%. So perhaps it is still high for the Federal Reserve, and therefore they might actually look into this and use the interest rate to again control, or the narrative is still remaining as a very hawkish tone to control the inflation, to make sure that inflation is not going up higher from this point onwards. It must go down to at least 2%. If not, the Federal Reserve will actually continue to increase the interest rate, and that is what the corporates doesn't want. Okay, so another thing is that the elevated interest rate environment. So this is also another fearful thing for most of the corporates out there, because if those people are actually borrowing from the banks and they have to repay, right now it's about 5% or 5.25%, that could actually affect their finance costs. So which means that if they have a lot of borrowings last time, they need to they need to repay the borrowings at a higher interest rate. So which means that it will hit their finance costs, and it will hit their earnings as well. So these are the areas that people are concerned of, and therefore if I'm one of the investors out there, I will certainly look into who has the high borrowings, who has high net cash position. I will separate these two all together. Okay. So on the CPI numbers wise, we can actually understand that the CPI numbers has been on the declining trend like what I mentioned just now, but it's not up to the standard of the Federal Reserve. Federal Reserve wants the CPI numbers to be at 2% year on year. So if this is still remaining at a high-ish area, the Federal Reserve will continue to maintain the narrative of they are going to be hawkish. Why is it so? Is because if they put the guards down and they start to say that we are heading in the right direction and we are trying to be dovish again, then people will start to say that since that the Fed is going to be more dovish, then let's inflate the stock market again. So that is a fearful part about that area whereby the Federal Reserve cannot let the guards down and cannot let the narrative change to dovish right now. So perhaps the recent Federal Reserve meeting suggested that they are going to increase another 2 more rounds, could be also to make sure that the narrative is still hawkish so that people wouldn't inflate the asset prices right now and make another inflationary, make the inflation numbers higher again. So the narrative right now for the Federal Reserve, it will still continue to maintain hawkish. And what I am thinking right now is that they are already in the right direction, because once they have increased the interest rate, the CPI numbers has been declining from 9% to about 4.9% right now, and that is a good sign. So perhaps this will continue to maintain, the elevated interest rate environment will continue to maintain at least for the rest of the year. So I'm not seeing a rate cut at least for until 2024. So that is my view on that. But a lot of people are saying that rate cut will happen in 2023. So let's see what is the tone out there going forward. But my view is that at least at this current moment they are doing the right thing to make sure that inflation number is down. Yes, it is down right now, and not hurting the GDP growth, which is still on an expansionary mode in the US side. So perhaps these two, if continue to maintain that way, they need not to increase further, they need not to do a rate cut also. So that's why I'm having a view to say that this year itself, at least they will keep the interest rate unchanged until December 2023. Then perhaps rate cut may happen next year. Okay. So this is the view of Federal Reserve fund rate, and the consensus is looking at the peak of the interest rate will be in the next few meetings or in the next 2 meetings, and after that it should turn lower. So my view is, to reiterate my view, is that I wouldn't see a rate cut this year, but at least it is not going to increase anymore further from this point onwards. At least until once these 2 rounds of increase in terms of the interest rate, then later stage it will pause the interest rate for until the rate cut maybe will happen in 2024. So that is at least my view for the time being. So another viewpoint that we have to take note is that what sort of forward-looking direction on the interest rate is by the Federal Reserve is actually going down for the interest rate environment. So until the longer term position, maybe 2024 is lower than 2023, that is the direction, and 2025 interest rate will be lower than 2024, and the longer term view will be lower than 2025. So generally speaking, right now could be already at the peak of the interest rate upcycle, and therefore going into the next few years we are looking into slightly declining trend for the interest rate. So that is also one, if you're investing in a longer term view, if this will help you, which means that you might want to take a look at a longer term view in terms of growth related stocks or technology stocks from this point onwards, because the technology stock has been actually rallying due to this narrative of having the peak of the interest rate environment right now, and therefore if you're looking in the longer term view of interest rate going downhill, which means that you might want to look into a longer term view on the technology stocks. So that is what we can deduce from whatever Federal Reserve is saying, the dot plot is putting and indicating, and to give you a view for a longer term position. So the next question is that when will be the recession? Because a lot of people are talking about recession, right? And what sort of indication that we have so far is still, US GDP is still, crawling or, marginally growing by 0 to 1%. At least there is still some growth in it. But they are actually mentioning about potential slowdown or potential, recession in the next 12 to 24 months. So what sort of indications that we have? First of all, we have the consensus looking at 65% of the probability that US is going to a recession. Since 2019, they are just, potentially 10%, going into a recession. Right now, they are saying that, US could be going to recession. There are 65% of chances. This is the consensus view. But another indicator that I want to point out is this. It is always a very good indicator to use. It is the inverted yield curve. Inverted yield curve happens during 2006 and 2007. Then the recession hits us in 2008. And during 2019, it has briefly dipped below the zero level for this the inverted yield curve happened in 2019. And after that, we have COVID-induced recession. And so right now, we are also having a dip during March 2022. And also recently, since July last year until right now, we are all this while in the inverted yield curve area. So which means that there is a very, very good chance based on stats to say that we might be going into a recession for the next, in the next 12 to 24 months. But again, it has already happened for the past 12 months. So where is the recession? People will be asking. So perhaps it may actually dip lower for two consecutive quarters on the US GDP, but perhaps some of the areas that you can actually look at will be strong profitable companies that you want to tap into, or even based on the past two rounds of recession, what kind of actions that you want to take. Because during recession 2008, it has recovered all the way up 2009 until right now. Same goes to 2020, the COVID-induced recession. When they mention it is a recession, it is potentially a good buying opportunity as well. So right now you have this in front of you. When they are going to announce it is a technical recession or even a recession, I think that is worthwhile to look at, because it might be a signal for us to enter the stock market as well. So I think this gives us an opportunity, not to say that right now we are anticipating this recession to happen. We shall take away, we shall reduce our position to zero in the stock market. I think that is very, very drastic measure. But I think as long as you have your plan in place, such as a cut loss plan or even target profit target area, you have to follow your strategy. So based on the understanding right now in the stock market is that it is not a uniform growth in terms of all the sectors. It is just the technology sectors that is actually moving higher. So how can you use that to your advantage? That is also another question. Okay, so back to our local front. Just now we have talked about the global concerns, basically the US bank crisis, elevated interest rate environment, and also the inflationary pressure. So right now, back to Malaysia. What is actually stopping Malaysia's KLCI to climb higher towards 1400 or even the 1500 level? I think some of the areas that we have to look at will be these three parts here. So first of all, we have basically our GDP is still growing, but maybe it's not as strong as people expect. And secondly, CPI numbers is coming down, but perhaps this is not felt by many of the mass population out there, because people are still facing a lot of basically their food, energy is actually food prices is actually going up. So it is part and parcel of their living costs, and that is also not they are not having good amount of disposable income to put into the stock market as well. So I think that is one of the things that people are talking about. But I think one major concern is about the state elections. So the six state elections are very, very crucial, and at least right now we know we have some clarity in terms of the election dates, and that is one good sign, because if you know somewhere in, I mean, right now we have known the 12th of August is the state election, and that is a good sign because at least people can position themselves based on this timeline to say that yes, we have about 6 weeks to go, or yeah, about that range of time to have the election, and perhaps they are able to position themselves ahead of this event by maybe purchasing into some of the construction sector, property sector, or even the technology sector, and by then they will offload the shares for that moment because people also don't know what is the outcome of the state election. So there are two things before we learn about the date of the election. People don't know about when is the election. So that is one uncertainty. Secondly, is that they don't know what is the outcome of the elections. So right now, at least one of the uncertainty has, get some clarity, which is we know when, we know the timeline of the election. So therefore, you can see the market has been rebounding over the past few days, and the profit-taking activities came in, today. So if we are having this first information, which is the timeline, people can invest and perhaps offload by then and wait for the outcome, and that will actually give them some opportunity during this period of time. Okay. So for the Malaysia GDP side, we have a very stellar GDP 2-3 quarters ago, but it has been gradually declining, but still at an expansionary mode, which is above 5%. So I think that should be expected, and it is not beating expectation. Therefore, the market did not really perform too well under this uncertain period. And we understand also the target that Bank Negara or Ministry of Finance is actually talking about 4 to 5% growth this year. So it is within expectation. So there is nothing to shout on this manner. But again, our CPI numbers is also on a gradual declining mode as well. So we believe that it is already normalizing based on this data, but perhaps the mass population didn't really feel it because they are still paying for high food prices. All these are actually catching up. Prices of their normal living costs is actually catching up. So just by these two data itself, we can actually potentially deduce that perhaps there is one more round of interest rate hike or OPR hike by Bank Negara Malaysia. So although a lot of people say that it will pause on the OPR for the rest of the year, but I think, in my view, if we can maintain the growth of GDP and also the CPI numbers is actually on a declining trend, or at least not growing as fast as 4%, then they are likely to continue to increase this OPR. Why do I say so? Is because if we are back to pre-pandemic level, which means that the CPI numbers is back to pre-pandemic level, and the growth is there and is similar to 2019, growth pace, then they can actually roll back this OPR back to 2019 level, which is 3.25%. So currently it's 3%. So I'm expecting another 25 basis point hike in OPR, at least in the second half of this year. Maybe it's not this round in July, but maybe in September or November. I believe that if the growth rate of the GDP, Malaysia GDP is as good as 2019 and CPI numbers is back to 2019 level, then that should be our benchmark of the OPR, which is 3.25%. So my view is that although consensus is saying that it may stay at 3% for the rest of 2023, but I think there is a chance, very, very good chance, that if we are back to 2019 level of the GDP growth or even the CPI numbers, then perhaps there will be another 25 basis point hike in OPR. So that is just my view on it. So that is the gist about the OPR hike this particular period. Then we'll come to the state election. That this is a concern, but also a catalyst for us, because if you notice the trading, once they announced, once we have seen the state assembly being dissolved, we have noticed some of the sectors such as property, construction, building material has been actually going up, okay, creeping up throughout this period of time. And once we have this the date being announced, 12th of August being the state election being announced, we noticed that some profit-taking activities has came in today. Okay, so that is just some analogy of buy ahead of the event, sell when it is a news. So buy on rumor and sell on news, these kind of actions. But again, after this pullback, I think over the next few weeks, we should be able to see another round of rally towards the 12th of August, and people might be positioning for the earnings season. Okay, earnings season. Secondly is that they might be positioning for some construction stocks to see some projects being dished out after the state election. So the risky part is that we are still unsure about the outcome right now. So perhaps if those investors are on the concern part, they might take a cautious view and stay aside for now. Okay, I mean that is just individual's preference. But based on technical indicators and based on all this recent buying flow, we can understand that some of the construction stocks has been going up, and some of the building materials and property stocks are up as well. So I think that gives you some idea about all this uncertainty can also contribute to very interesting stocks ideas or sectors picks as well. Okay. So let's talk about economic review, because we have talked about global concerns, we have talked about Malaysia's catalyst, but what sort of areas that we can actually look at so we can actually drill down into economic activity. Okay, economic review, and let's see, generally speaking, the CPI numbers on overall US, UK, Eurozone, Malaysia side, Japan side has been actually coming down after hitting a peak a few months back. So CPI numbers has been declining trend, but like I said earlier, the Federal Reserve or the central bankers cannot put their guards down, because if they turn their they're turning their view or narrative into more dovish sides of things, then it will cause asset prices to inflate again. So that is not what the central bankers wants. So I think the narrative right now is still maintain the hawkish tone for most of the central bankers, and therefore that is because the CPI numbers has not stabilized until whatever target that they wanted. So that is just, I think they are being hawkish for a reason. Okay, but at the same time, the economic outlook or economic activities is actually very robust, and unemployment rate has been going down to record low, and again we can see non-farm payroll has been going up as well. So but perhaps the resilience of the economic activity is there, and so they are not really threatening too much on that side. So perhaps they are maintaining hawkish, but at the same time you can see that economic activities are still growing well, so they just stay put on whatever they are doing right now. So on China side, GDP growth is actually expected to be still positive, about 4 to 5% GDP growth, and US side is also about 0.7 to 1.9% over the next 3 years. And this consensus forecast is looking at 0.7 to 1.9. But basically throughout the past 5 to 6 years, you can see that US GDP just is growing at 1.7 to 2 to 3% range. Okay, so if they manage to they are looking at just a 0.7% growth in 2024, there is a very good margin of error there to say that perhaps in 2024 there could be a dip into a negative territory. So I'm just giving you an idea that consensus is looking at a softer pace of GDP growth in 2024. So if we are looking at the consensus is looking at below 1%, the margin of error is quite is there. I mean, the probability of that going to recession is also there, because generally speaking, the US GDP has been growing at an actual rate of 1.7 to about 4 to 6% over the past 6 years. So that could give you an idea that perhaps the US GDP side may have some error to go into the negative or the contractionary phase for the economic activity. So that is what I want to point out, because that is 2024. So it's still very hard to forecast, and even Federal Reserve is also perhaps scratching head on whether are they going into the recession as well. So I think we just have to rely and depend on the data month on month or Q on Q in terms of all this data going forward to determine whether they are going to a rate cut or even they are going to increase of rate going forward. So another thing in the stock market is about liquidity. We have been flush with free money and the flush with abundance of liquidity throughout the past, I think 5 to 10 years. Right now, they are actually into the tone of quantitative tightening. So although there is a spike in terms of the balance sheet recently after the banking crisis, but you can see after that it has been also coming down. So which means that it is definitely on the path of on the quantitative tightening era. Just that we are still having a lot of liquidity despite the declining of this federal bank balance sheet. So what I'm saying here is that although it is on a quantitative tightening mode, but it is actually still a lot of abundance of liquidity. Just that the narrative right now is not the same anymore versus the free money era. So we have to be very, very careful and very, very selective in terms of our stock picks going forward. And right now, it is not a zero interest rate regime anymore. It is 5% to 5.25% interest rate right now. So therefore, it is a huge drastic difference as compared to before COVID. So I think the idea behind this, we have to be very, very careful in selection of stocks. Yeah. All these recent earnings has been also contributed to some beating of earnings. All these reports, recent results season, it has actually contributed to near to 80% that the corporate earnings are actually beating the consensus. In terms of the strongest area, I think is in the technology stocks or even the industrial, about 86% beating the forecast. Whether is it they are growing at a very strong pace, or because the analyst is dropping their forecast so that the corporate earnings is easy to beat the consensus. So we have to also drill down to that. But generally speaking, what I always like to do is make sure that quarter on quarter the stocks is actually growing. On a year-on-year basis, they are actually growing. That is a good indication that even under whichever environment, they are able to pick up in pace in terms of their earnings. That is a good company. So we want those companies, and there are a lot of companies on that segment. So which means that you can easily find that quarter on quarter basis, under this inflationary pressure, under this interest rate elevated environment, they are still making money. So why is it so? Because their management execution is well, and therefore their earnings is great. So if those companies that are able to generate strong Q-on-Q growth, or decent Q-on-Q growth such as 10 to 20%, or year-on-year growth of 10 to 20%, then I think that companies serve and suit our filtering criteria. So that is one thing I always want to find out. And this year itself, a lot of tech companies or a lot of companies are actually going down layoffs and workforce reduction. And this is very crucial. Although you can see that they are anticipating that demand for their products are softer, but at the same time, once they are able to lay off or reducing their workforce, they can straight away save a lot of money, and that will boost in terms of their earnings. So these companies can be taken as a short-term negative because of they are anticipating that their revenue or demand for their products are lower, but at the same time, on a longer term perspective, it is telling you that they are saving more costs to generate more earnings going forward. So short term pain and long term gain, I think, is the way to look at in most of the companies under these workforce reductions. And a lot of times media will pick up all this. They wouldn't say that, biggest hiring, in 2023. They will always focus on negative part of things. So right now we can see that they have been, reducing their laying off their workers, but whether they are actually hiring mode or not, then whether is the media picking up that kind of news, it is a question mark. So I think just now what I mentioned is, in short, this move will be a short-term pain but long-term gain kind of, it might play off in that manner. So I would say that under this year of efficiency, you can see that most of their cost is reduced, and therefore earnings will come in perhaps in the next few quarters. And let's see, and we let the data, or we let the numbers speak for us, okay? And all this Federal Reserve or the interest rate hike environment has been contributing to dollar index very strong in earlier days, but right now it has stabilized along the 101 to 102 level. I perhaps this is a very stable trend unless the Federal Reserve continue to hike further in terms of their interest rate, and I would see that this will be stabilizing along this 101 level. There shouldn't be too much spikes in this dollar index going forward, but if dollar index continues to stay strong, that is actually negative for companies in US, because like for instance, Malaysia side is like export country, right? Export nation. Our corporates likes to have such a weaker ringgit, because once they export, they can translate more US dollar or whatever dollars back to their earnings, and that is good for them. So if dollar index is continuing to go strong and have a lot of volatility on the upside, then perhaps that will be dampening their earnings visibility for the US corporates, because US corporates have a lot of earnings or revenue coming from all over the world. So that's why if their dollar is actually strengthening, it's actually sort of like a negative thing for those companies. So as a corporate, you want actually a stabilized dollar, and that is what I see right now. As long as it is still hovering around the 101 levels for dollar index, I think that should be fine for most of the corporates. So they can actually have the mentality to prepare on their whatever hedging policy, or how to procure the raw material costs and things like that. Yeah. So on the commodity index is coming down, so we just have to understand this is that if the commodity index is going down and stabilizing around this range, it is telling us that most of the CPI numbers will actually continue to stay in a downward trend. Okay, so at least if the Bloomberg Commodity Index is showing that it is on a downtrend phase, then perhaps it should be helping the CPI numbers to continue to decline further, which means that it is good for the Federal Reserve, because they want the inflation numbers to be around 2%. So this would give you an idea that we are potentially having a view on the CPI numbers to continue to decline further. And on Brent oil prices, I believe that this is very, very useful for us to determine whether we want to continue to invest in or continue to trade within the oil and gas segment. I think so far it has been quite stable around the 72 to 75 range for the Brent oil prices. So as long as it is at this level, it is actually higher than a pre-pandemic level, and that should actually help those E&P exploration and production players. But at the same time, when it translates to the going down the value chain, I think that all those companies will actually benefit. So recently also some of the companies in Malaysia has been actually moving into higher territory, and perhaps they are also anticipating that some of the to be dished out going forward. So I think Brent prices, as long as it is stabilizing along the 72, 75 US dollar mark, I think that should actually will be quite fine and should bode well for most of the oil and gas counters. And I think Warren Buffett is still buying into Oxy, right? So that could be one of the areas that you can actually look out for, because Warren Buffett is buying. Perhaps you want to get some exposure into it. Yeah, so that is sort of the narrative out there. So on this CPO, and CPO recently has jumped above the SMA 200 level, and this is definitely on a recovering trend, and this might help those traders in local front to trade on plantation stocks, especially rumored on Bao State Plantation and also some of the other players like Jaya Tiasa, TSH. Also, they are actually making a very good strong moves after this CPO price has been actually going up. So you can actually gather all this information and form your thesis to trade into which sector, and what are the areas that look at, and that will help you to form your own thesis for your investment purposes. Yep. So another area that we can actually monitor is that the retracement phase in gold prices after the banking crisis has been sort of like averted. The banking crisis in US, it has not going up higher and higher for the gold prices. So we can see that if there is no crisis, then perhaps these gold prices shouldn't even trade above the 2000 level. So if you are trading into Malaysian stocks on this gold related segment, I think when gold prices is surging and strong movements upward, then maybe you want to take a position in Pokong, Tomei, or even some of these YXPM. Yeah, so these gold related counters. But as of this juncture, I think it is in the retracement phase, and especially gold related counters normally is like 1 day or 1 day show, or even they can really gap up the next day and come down later stage. So I think it's very, very challenging to trade within gold related counters. So I think you have to be extra cautious on trading this counter. Okay, so far we have covered the recovery team, global and Malaysia catalyst, and right now we are talking about what sort of market reactions and what sort of movements that we have seen in the global market. So or even comparing global markets versus Malaysia, where are we right now? So in terms of the year-to-date basis, SPX, China, and also KOSPI is actually up. They are performing well, but at the same time, we can see that FPM KLCI is struggling, and also Straits Times Index year-to-date wise is also down, and Hang Seng Index is down as well. So it is very diverged, and we cannot see a real trend. But generally speaking, if you are looking into a very strong gainer, that definitely will be on the US side. US markets is actually growing higher. Later on, I will share you a few slides whereby why what sort of drivers are there that boosted the S&P 500 so high. And in terms of valuation, earlier on we are around 18, 19 times PE for S&P index, but recently it has jacked up towards 21.3 versus their 10-year PE of about 20.4. So it is slightly more premium in that sense, but again, we can understand the overall picture is actually it is quite fair to say that right now it has actually moved up towards near the mean area. So it has mean reverted to the mean going back to the average area. So perhaps if you want to have more upside, which means that you need more earnings to support. So whether those companies can actually provide earnings, we have to really monitor by second quarter or third quarter. So that is the whole idea here. KLCI wise is still in the discount phase. Perhaps we are having this discount for quite some time, and over the past few market outlook, we are already mentioning about KLCI has been on the lower end or discounted area. And if you notice that this PE of 15 is actually quite far away from the 10 years average of 17.5 times. So perhaps after all this, after G15, we still have state election to go through. So hopefully after this this state election, that we can see some light at the end of the tunnel. Hopefully, so once we are more stable in that sense, and once we know the outcome, then the market should be able to position themselves accordingly. So last piece of puzzle, I think, is the US dollar MR trend is also on a weakening path, and we are heading towards, this is certainly good for the exporters, but at the same time, it also will dampen the buying opportunity of our mass population. So that is some of the dilemma there, because export companies likes, the weakening tone of US dollar MR trend, but at the same time, some of the companies that import a lot of raw material from US or even other currencies, they are actually being affected. So corporate side will need to do some hedging or doing some cost pass through to some of the end users. So that's for sure. So weakening tone may actually affect the sentiment overall in our local front as well. So what are the themes that actually we can look at right now? Because we really running out of ideas, or we are really, investors are really running out of ideas. What sort of areas that they can actually look at? So I would suggest that two themes. One is the AI, because AI has been all this while very fiery since the very hot since January of when ChatGPT is out, and NVIDIA's has rallied for more than 150% since the low. And also metaverse, I think this is a return, this is a return of the metaverse, because after the headset of headgear, Apple Vision Pro, right, has been announced by Apple, I think it will introduce a new, it will come back, this theme will come back. So I think it may not be, the term of metaverse, but it may be some other thing. But I think the headgear give us some ideas on what sort of trend that we can actually look forward to. So these are the two major things that we can actually look at right now in the market. So we are actually promoting three markets right now: Malaysia, US, and Hong Kong. So later on we can actually talk about this on our stock picks segment. And yeah, so this is just by capturing some of the Google trends to understand whether AI is it still in play, or AI is it on a retracement path. So I have pulled out these two information here. One is AI content, one is generative model, which is related to AI, and it is still at elevated area. So perhaps the AI trend is still there. But one thing is that the rally has started since January, and right now they are waiting for the earnings, whether that all these AI usage are actually translating to earnings or not. That is when the second quarter results coming in this end of July and early and in month of August, or even during September, October, November period. That these two quarters we need to see. The market need to see, because it is always ahead of all these events, right? All these earnings season, they expect the earnings to come up better than expected. So if the earnings coming out in second quarter or even third quarter is actually not up to on par with their expectation, then perhaps they have to sell down because the PE is too expensive. So right now, they're actually awaiting. They are trading higher to wait for the results. When the results out, they will know that whether they beat or they are lower than expected area, then perhaps they will see some sell down. So so AI stocks has been great in the first half of this year, but it must also be on par. The earnings must be also on par with that area of trading. Yeah. So let's come to the S&P 500 total up. We can see that S&P 500 has been going up higher, but what has contributed and how much of the companies has contributed to that growth? So we have taken out this data from the Bloomberg, and we can understand that all these 7 companies are actually contributing to more than 75% of the increase in terms of the points for the S&P 500. S&P 500 has grown year to date about 600 over points. This has actually contributed about 400 over points. These 7 companies itself. So basically, AI is really the trend, okay, for these 7 companies. But whether the earnings coming in the next 2 quarters, that is very important, and therefore the market will actually watch whether they can beat the earnings or not. Okay. So yeah, so we have to monitor on this Apple and Microsoft, Nvidia, Tesla, Amazon, Meta, and Alphabet, yeah, Google. So yeah, so basically these are the 7 companies that made this kind of movements. So we have to really monitor whether their earnings can catch up, or if they are lower than expectation, then perhaps the selling pressure will come in. So this is taken from one of the slides from COA, TUE, East meets West. East meets West. Yeah, it's very hard to pronounce. But again, it's telling us that because of the liquidity or the quantitative tightening, the liquidity is not there. People will select the best companies out of all these companies. So that's why if you're looking at money-losing companies, they might not be able to recover as what you think, and their recovery is definitely the slowest. So people or investors will definitely look at the strongest earnings companies to look at, and therefore that will be our filtering model. So our filtering model is systematic approach will be at least Q-on-Q growth, year-on-year growth on the earnings, and that will be part and parcel of our systematic approach in the US and also Hong Kong stocks. And this is also taken from their slides. Yeah, era of the free money is gone. Right now we have to return to reality, 5% risk-free rate, and we are looking at potentially lower growth because people can't really, take more borrowings to grow their business. They might need to have enough cash to grow their earnings going forward, and we are coming back to rational valuations. We are coming to more efficiency, more innovation part of things. We are looking at more profitable growth companies. Yeah. So in short, what sort of strategy should we actually deploy? That is the main question on third quarter. So we have crafted a few strategies, but I think this model works at least for the past 4 quarters in Malaysia side, and it has been working for first quarter for Hong Kong and US. But you can also say that US is very easy because those companies that has beat earnings or related to AI has actually performed well. So how good is good? We have to benchmark against the S&P 500 index. So later on I'll share with you on the stock selection in Market Outlook second quarter, what sort of stocks that we have selected and what sort of performance they have given us based on these 10 stocks. So like I said earlier on, the key takeaways from this market outlook is definitely we have lesser liquidity to deal with, and therefore we definitely need to look at stronger earnings Q-on-Q, year-on-year, and profitable companies, high efficient companies. If they cut costs, is actually good for their survival and they can actually boost their earnings. And is there a chance for recession? If yes, then that could be a buying opportunity like in 2008 or even 2020. Yeah, so tech giants are trading at premiums. Are their earnings quality managed to support their share price right now or their PE multiple right now? And where is the next growth area? I would say that perhaps AI, but also we need to see the earnings come in for AI. Let's say, for instance, you are buying to Nvidia at this price, but again, when the earnings comes in, it is actually lower than expectation. So what should you do, right? So you have to understand that it will correct. You will retrace towards a safe point or a good consolidation area zone for you to buy in. Okay, and I think the metaverse earlier on that people has actually mentioned, or this term might actually come back, because I think Apple Vision Pro is giving that opportunity to see a comeback in 2024. So let's see whether we are right or not, but I believe that the headgear is the new trend going forward. So I think perhaps that could allow more areas of growth for different companies related to Apple. So Apple could be the leader in this, despite a lot of players out there have tried this metaverse, even Meta itself. So let's see whether does it make sense for this metaverse to come back by then. Okay, so let's do a quarterly review. Basically, we have crafted this strategy since last year, third quarter. So we have done one cycle. So in since we have been using this in third quarter 2022, it has garnered us about 13.8%. Fourth quarter, it has garnered us about 6.8%. The third quarter into this model is garnering us about 5.3%, and the recent quarterly, we have not made any gains. It is losing by 0.9%. But benchmark against the small cap index or even the KLCI, we are still overperforming them and outperforming them. I think one of few of the counters that actually made a very good performance is Infomina, and also Rand Hill and T7 Global. So these are the, this is one of the structure that I've been making so far. So hopefully that this can actually sustain for another quarter or so, or another few years or so. Yeah. So for systematic approach in Hong Kong itself, we are, these are some of the companies that is stated in the last round of market outlook, and the performance wise has been quite alright. It is averagely, if you buy equal weightage on all these 10 counters, you can get about 3.4% return for that particular quarter versus Hang Seng Index. It is down by 6.7%. And for US approach, these are the 10 counters that we have presented during that particular quarter, and the returns are about 9.2% as compared to S&P 500 is about 8.5%, still outperforming them by a marginal 0.7%, but I would say that it's just on par, because after the transaction cost, maybe it's just on par. But yeah, we are just buy into these 10 stocks. Yeah. So in Malaysia side, this quarter, what sort of areas that we want to look into is definitely we are going to monitor whether is there any more opportunities after the state elections. But if you are looking into just this strategy approach, we have topics later on. The 170 billion investments via the 19 MOUs, perhaps to be focused after that, because right now everyone is talking about state elections. No one actually been looking to these MOUs. So after the state election, perhaps more stable government can provide us more insights or more details towards these 19 MOUs, and benefiting who? It will be construction, property, building material segments, and things like that. And definitely year of the AI and also renewables, such as green energy or EV, can be also part of the play as well. Cash is definitely very important, as I mentioned a lot of times. Into this high interest rate environment, people will be focusing more on high cash, low borrowing kind of companies. So based on that kind of criteria, based on that kind of resilient that kind of environment, what stocks that we have introduced for you this quarter is this list: Advanced Corn, Charimin, Ecoworld, M Cement, OSK, RSCE Cap, Cycom, SFP Tech, Teosing, Uchitech, Wasco, WCE Holdings, and also YTR Power. So these are quite a diversified portfolio that covers technology, finance, property, construction, and things like that. So I would say that this structure of us using this systematic approach is providing us some of the good basket rebalancing kind of portfolio. And so far, this going into these 2 days, it has garnered us about 1.7%. Although maybe you can say that market has been quite great and we are timely, but this is definitely a very systematic approach to go quarter on quarter basis, and we are using a very diversified portfolio. So just give you an example of what stocks that currently are still looking good and can monitor for breakout is Ecoworld, because some of the 13 counters that has actually been rallying quite sharply over the past 2 days, like Malaysian Cement, they have went up strongly. West Coast Expressway has been going up strongly. So these are some of the companies that has not been performing so well yet, but still we might be able to look for opportunities such as Ecoworld. On a weekly chart is looking at like a flag formation, potentially a breakout soon towards 95 cents. And SFP Tech, this is one of the uptrend in tech companies. It has been going up strongly. So we are monitoring whether it can continue to move up towards 115, 126. And even this advanced coin is just in the midst of consolidation phase. I would say that once the state election is done and dusted, then we might be able to see some potential upside on the breakout note on advanced coin. Okay, so on the US side, these are some of the 10 companies that you can actually monitor: Microsoft, Alphabet, Nvidia, Meta, Visa. My approach is very, very simple. You are just filtering out the Q-on-Q growth earnings growth companies, year-on-year growth companies. Then you are selecting based on uptrend companies. SMA 50, 150, and 200 will be some of the parameters I use. And you can, I'm just using a very systematic approach to select the top 10 market cap companies from that list. So these are the 10 companies that came into the list. So it covers from semicon, technology stocks, banks, financial services, to media and services. So basically it's the best 10 companies under this filter of strong growth and also uptrend momentum companies. And so last round it has given us about on par returns. So hopefully this quarter can actually provide us with that as well. So one of the stocks that two of the stocks that I want to present to you is Visa. Visa is actually having some breakout right now, so hopefully that it can sustain. As you understand, during this period of time, a lot of these discretionary, consumer discretionary stocks such as cruise has been actually going up higher and higher. So LVMH has been going up higher and higher, so which means that people that can spend can still spend. And so Visa is the transaction, when you pay Visa, the transactional cost will bring them revenue. So those are the areas that you can actually look at. Another company is JP Morgan, just started for breakout, and perhaps they can actually continue with the uptrend mode right now until perhaps the next banking crisis, which is we feel maybe down the road until the end of this year. Then when they pick up the news on the bank term funding program is coming to an end, what sort of banking outlook that they might go into, then perhaps JP Morgan can actually trade from this point until that period. Okay. So from the Hong Kong side of approach, I think very few of the companies are in the uptrend tone, so that's why it's very easy to select. But these are some companies that has been coming in during the second quarter as well, like PetroChina. But this round there is some differentiation here. Where we can see that automobile is coming in. I saw someone is talking about asking. Rahman Nasir is asking about what is the EV prospect in Malaysia. Any good stocks in Malaysia? Or in the market itself. So I would say that Tesla perhaps is one of them, Nikola can be one of them, but if we want to really pick and drill down to all these EV counters, I think you have to select those counters with earnings, such as Tesla, such as Li Auto. So in Hong Kong, we have this top 10 approach as well. In the US, we have that as well. So perhaps you can use this kind of idea to provide you with some, to craft your portfolio out for the third quarter, because we are using this systematic approach, and it has been garnering us a very good profit in the recent quarter. Hopefully that it can still generate this. If they can't generate the earnings, then perhaps next few quarters we have to continue to monitor or continue to tweak whether how we want to take this approach going forward. But again, since that this is giving us some good profits, at least 5% as a total portfolio in US, Hong Kong. So let's see whether does it give you another 5% in the third quarter. Okay, I just want to bring out a few, I think one company, which is Li Auto, I think is riding the EV trend. Right now, I think they are one of the still profitable EV makers, EV producers, and therefore we might be able to see some upside potential for Li Auto. Yeah. So these are some of the areas. If you have any questions, I maybe can take about 5 questions for now. Yep. So what's LK Kong is asking, what are the construction projects might affect on the outcome of the state election? So I would say that right now people are not really so interested about getting projects, but they are more towards looking at what sort of election outcome they can get first, because if they can't really get most of the state government kind of seats. Therefore, it is quite struggle and quite challenge for the government to continue, to get more contracts out. Okay, so that is first thing. I think once we have a stabilized political environment arena, then we will be able to see potential in contracts. Recently there are some news talking about high-speed rail. These are things like that will actually trigger a lot of buying opportunity. So high-speed rail has been contributing to speculative mode in terms of YTL, and even YTL power has been contributing to the earnings of YTL as well. So YTL has two positive catalysts to trade as well. So these are the areas that you can actually look at for construction players. But recently also I noticed that Ahmad Zaki, AZRB is also actually going up strongly above the 25 cents level. And WCE Holdings, I think this is one of the stocks that we have been continuing to mention in our market outlook, or even in our group chat with our remisers and dealers. We continue to discuss about WCE Holdings because of the construction phase is still ongoing, and they are opening up the West Coast Expressway, and that will contribute to earnings going forward. So it is similar to Duke Highway and contribution towards the EcoWest earnings, or similar to Plus Highway contributing to Plus earnings last time. So these are some of the ideas, and right now it's just 60 over cents. I believe that the share price can also trade towards one ringgit level. So I think that is the whole idea about the construction segment, and perhaps we can actually look at a proxy of the construction sector as well, because if you notice that the recent cement price is also very interesting. After Hume Industry has actually released their results, they have been not coming down. The share price has been going up strongly, and even Malayan Cement, after we have mentioned in our market outlook, it has actually been garnering attention, and it has been trading higher and higher over the past 2 trading days. So I think be it construction, be it the building material, and also the property segment, I think these three are could be could be some of the winners in third quarter. Okay, what AI stocks in Malaysia M Plus recommend? I think AI stocks in Malaysia is quite rare, but if you want to have similar kind of context, or similar kind of counter that we can actually look into could be Opstar, because Opstar is a design chip designer, is similar as Nvidia. So this is one of the chip designer in Malaysia, and therefore this could be one of the companies that you can actually look into, which is Opstar. And if you want to talk about the later stage of things, such as the support and services or the test equipment segment, then a lot of stocks you can actually choose. But one thing to firm up into, to come into our filter, it must have a Q-on-Q growth, Q-on-Q growth in terms of their earnings. So if that didn't even fulfill at the first place, it shouldn't come into that. But as we understand, SFP Tech is still growing in terms of their earnings, and it has been in uptrend tone, and therefore we are putting it in our market outlook for the time being. Okay. So if you ask me AI stocks, I think you can actually look into Opstar, or you can look into technology companies that has been making profitable track record over the past at least 1-2 quarters, because I know that a lot of companies has been declining in terms of their earnings, and therefore it is not coming into our filter. So our filter is very stringent that only Q-on-Q growth, year-on-year growth, that stocks will only come in. Yeah. Okay. So so this is some of the areas, and if you all have any more questions you can ask. I saw one is any inverse ETF or index that we can look at. I think if you are looking at inverse ETF, it's very, very tricky. If you need to time it well, to make some good gains. Although yes, right now it might be a very good opportunity. You want to sort of like do the shorting position. You can actually look into inverse QQQ or inverse SPY, SPX. Yeah. So those are the two segments or two indices that if you believe that your thesis is correct right now, is on higher valuations, that you see a retracement coming in for SPY and QQQ. These are the area that you can actually want to look at. Okay. But I would say that it will be just a short retracement. Then once the earnings are able to pick up, once the share price retraces until a significant retracement area, then I think it should be able to see some upside potential from that point, because everything needs to be supported by earnings, and if earnings is still vague and unable to see earnings visibility at least for the next 1-2 quarters, then perhaps it shouldn't fall under our earnings growth filter. Okay, so I guess that will be it. Yeah. Okay, thank you so much for your time tuning in to this market outlook section. Then we'll see you again in the next 3 months. Thank you.